the best advice I gave anybody on crypto was back, and this was because of my friend Grant Williams in the summer 2021, get your Bitcoin off the exchanges because the exchanges look extremely hazardous, which turned out to be true. So it's such a high risk area with so many imponderables and unknowables. I think they're great trading vehicles, and I would probably use technical analysis. It seems to me that when these things get absolutely crushed and greatly oversold, there is a trading opportunity. And I think you've got to be honest with yourself. You've got to look at it objectively. And that's where I think, look at the price chart. When you see the price chart just go straight up, that's a bubble. And it's just a question of how far it's going to keep going up. And you can either make that work in your favor or you can get destroyed by it. And unfortunately, I think most people get destroyed by those types of moves. It could be the biggest pool of capital on the planet. But somehow we didn't do it, and somehow we don't criticize our policymakers for allowing that to happen. Well, now we have to deal with that. Now we have to pay all these boomer retirement benefits without any money to do it. Where's it going to come from? And I think at some point the younger generation said, well, I'm not going to pay higher taxes to pay for my parents' Social Security that is now, there's nothing there. So it has the potential to create some very, very severe intergenerational strife. There's just no way the economy can possibly support that.
Hey David, how's it going?
It's very good to see you. That's we're how many time zones apart? 9 different time zones apart, but it's like you're right next to me. This is pretty cool.
I know, and it's great to finally. It's pretty crazy actually to speak to you because I've been following your work for a while. And I mean, I was looking just quickly at like your previous kind of your jobs and that sort of thing. And you seem to be an unbelievably steady guy working like 11 years at one place, 12 years at the next. And it's apparently 21 years now at Evergreen Gavekal. So yeah, I'd love for you just to kind of give readers a little bit of your background and I guess what you currently do.
Well, my background. So it's pretty prosaic, really. I mean, I started as your standard issue smiling dialing stockbroker back in 1979 at Dean Witter. And like you said, I was there for 11 years and then went to Smith Barney for 12 years. And ironically, both Dean Witter and Smith Barney wound up part of Morgan Stanley. It seems like Morgan Stanley's gobbling up the financial world. But my goal was always to try to be a portfolio manager. But since I came out of college with a degree in cinema studies and filmmaking instead of in finance or PhD in economics, I was going to be a filmmaker, and that didn't work out. I decided pretty early on that being in the film industry and eating weren't compatible. So I'd always loved the stock market. If you can't succeed at filmmaking, you go into the stock market. Right? Everybody does, but no, it's
very opposing.
Say again.
Sorry, no, you it buffered out. You continue.
Well, it was a fascinating time to start out in the financial industry because in 1979, of course, we were dealing with a high level of inflation, and inflation had been getting more and more out of control, really since the mid 60s, and in the first few years of my business, it got worse instead of better. Inflation kept going up, interest rates kept going up. But of course, in 1979, something a little bit more significant happened than me joining the financial industry, and that was that Paul Volcker was made chairman of the Fed. And Volcker then proceeded to drive the prime rate to 21%. He created real interest rates of 8 to 9%, and that, of course, destroyed inflation. It clobbered the economy at the same time. And as a result, to this day, a lot of people think that he was, heartless. But I think he did exactly what needed to be done at that time. And it really created a 40-year tailwind for my career because I believed in, for that period of time, that we were in a disinflationary era and that any major sell-off in the bond market where yields would spike, particularly late in an economic upcycle, it was a buying opportunity. So it really dominated my career for 40 years, and it didn't change until the summer of 2020 when the 10-year Treasury note went all the way down to 0.5%, and the money supply was going absolutely vertical. And of course, we were doing full on MMT, modern monetary theory, in this country. And I believe that was going to create a lot of inflation. I believe it was going to kill that 40-year bond market. And guess what? It did.
Which leads us on to your largest piece of work, Bubble 3.0. And before we dig deeply into that, I'd love for you to kind of give as if you were explaining to, say, your son or your daughter what a bubble actually is, and then once we've kind of gone into that, the history, and then your thesis of where we are now.
Well, that's a very good question. I rarely get asked, but in my case, I would say it's my grandson or granddaughter. You got to remember how old I am. So I actually work for my oldest son. He tells me what to do on a daily basis. But if I was explaining it, actually, I did have one of my granddaughters ask me here recently to explain what I did, and it was pretty cute. And it's I didn't use this example with her, but I'm going to use it now because we have an adult audience. It's kind of like years ago they asked Supreme Court Justice to define pornography, and he said, "I can't define it, but I can recognize it when I see it." And I think that same logic applies to bubbles. That it's very hard to actually describe a bubble. I mean, I'll make an attempt, but I think you just can visualize it so much easier. And when you see the graph or price chart of anything, whether it's a crypto or whether it's a commodity or whether it's a stock, and when it hits that straight up vertical type of thing, you're in a bubble. Now, I would also say that, from a fundamental standpoint, it's when there's no fundamental justification for the price. It becomes surely a momentum event. And usually when there's a powerful momentum event, one that's significant enough to create a bubble type of signature, is that you have a narrative. There's some kind of a story that goes along with it. And I mean, for example, Kathy Woods, she is one of the great narrative spinners of anybody I've ever met in our business. I mean, she's really persuasive. And when you combine that kind of power of persuasion with prices that are going vertical, I mean, that's catnip for investors. It's just very hard for people to resist that. And part of the reason is that when you get involved in those kinds of things, and there's the old saying, which I think there's a lot of truth in, is that a bubble is a bull market that you're not invested in and that your brother-in-law is, whereas a bull market is one that you're invested in. And I think that's true, that there's a tendency to rationalize bubbles if you're in them. And obviously, I think the correct way to play a bubble, and if we're fortunate enough, we get involved in those sometimes. Hopefully, they start out as something reasonable, and then they take on a life of their own. And the proper way to deal with them, in my view, is to sell into them methodically. We're big believers. We should be big believers in the power of dollar cost averaging. I know with individual securities, it's more treacherous, but certainly with sectors and the market overall, dollar cost averaging is a proven way to enhance returns. But people only think about it, if they do think about it at all, they tend to think about it on the buy side, but it's also true on the sell side. I think you can add tremendous value to returns over time by following a dollar cost averaging sell approach, and particularly when you get into these bubble environments. But people will do that. What do they do? Once they get caught up in something, whether it's crypto or a profitless tech company, maybe the largest EV company on the planet, to name one fairly specifically, they tend to buy more as it goes up and up because they get instant gratification, and humans love instant gratification, right? It's a confirmation that you're right. And unfortunately, and it works for a while, but unfortunately it becomes a tremendous sinkhole for wealth because you're constantly buying at higher and higher prices. And at some point, that parabolic move has the flip side, and it goes the other way. And so people, instead of just losing profits, they end up losing real money. And, that's why when you look at, say an ARC fund where from inception, the performance numbers are still very, very good. But when it started, it was a very small fund. As it became larger and larger is when, again, for a while, the numbers were still outstanding. But eventually, going back to 2021, it rolled over way before the market. And that's when it had attracted, tens of billions of dollars. And amazingly, it still attracts money even as it's gone down, which would tell me that perhaps the final flushing out hasn't occurred yet. But it's, I just think people they're again, they tend to rationalize if they're involved, it's not a bubble. If they really believe in the story, it's not a bubble, it's a bull market. And I think you got to be honest with yourself. You've got to look at it objectively. And that's where I think, look at the price chart. When you see the price chart just go straight up, that's a bubble. And it's just a question of how far it's going to keep going up. And you can either make that work in your favor or you can get destroyed by it. And unfortunately, I think most people get destroyed by those types of moves.
And I mean, especially like when the narrative is so strong, be it say like the internet is going to change the world or like crypto is going to destroy the banking system or whatever. And then people kind of put a bit of money in, see it doubles and they're like, oh shit, it actually is going to change the world. And then if you think it's an outcome so large as changing the world, then you can kind of justify higher and higher prices forever, essentially, because you're like, well, why would it come down? It's going to like do X, Y, or Z. And I guess that kind of ties in, like you mentioned bubble 3.0. And so what is bubble 1.0 and what is bubble 2.0? And then once we kind of have an idea of that, I guess like how does bubble 3.0 then compare to these?
Also, a very good point. So bubble 1.0 was the tech bubble that happened in the late 90s, like you said, when the internet first captured everybody's imagination. And it's interesting that bubble 1.0, 2.0, and 3.0 are all connected. And I'll explain that in a moment. So bubble 1.0 pops, and you had a tremendous amount of pressure on the Greenspan-led Fed at that time from people like Paul Krugman at the New York Times, Nobel Prize-winning economist. So I think that one should be revoked, but we won't go there. But he did repeatedly encourage the Fed to create another bubble, and they complied. They drove interest rates down to Great Depression levels in 2001, 2002, 2003, and it did create that bubble in housing that Krugman wanted to see. And he did, once he realized, kind of like Dr. Frankenstein realized what he created, and that he better, start warning people that this wasn't going to end well. And of course, it ended horribly. And that's actually when I started writing my newsletter for the first time. At that time, it was called the Evergreen Virtual Advisor. Now it's under the Haymaker banner, where we create Making Hay Monday. And then we also do our highlight reel on Fridays. But anyway, that was the first time I really wanted to go on record in writing with repeated warnings that this was going to end very badly. And as I saw these mortgage products being created and all the packaging up of the CDOs and the CDO squared and taking subprime mortgages and making them into triple B, but even triple A rated different tranches, it was just, it looked like an accident waiting to happen. A huge financial accident, which of course it did turn out to be. It almost crashed the global financial system and required the TARP, the Troubled Asset Relief Program, which the government actually made a lot of money on. And back in 2008, when they were first doing that, 2009, I was telling my readers that this thing is going to be a huge moneymaker for the federal government. Now, if you wanted to make an outlandish and controversial prediction that would really get people upset, that was it, because everybody was convinced that it was just a giveaway to the big banks. And yet it was a huge taxpayer windfall, but that's another story. Unfortunately, the government didn't do that same thing in the COVID bailouts. They didn't get this, because the reason the government made so much money back in 2008, 2009 on TARP was because they took warrants on these bank stocks. So the bank stocks were, blown to nothing. So the government, they don't very often do something smart, but they did. It was actually a reprise of what Lee Iacocca, or what the government had done with Chrysler. And Lee Iacocca came in to rescue it, but the government took warrants on Chrysler and made a killing. It's a good model. I mean, if you've got to bail out companies, get some kind of equity kicker. And it's an interesting combination. And once you come in there and you cure the financial system with the government's unlimited balance sheet, then you instantly create a winner. And that's what they did. But Unfortunately, what they also did, and frankly, I think if they'd done that and done that early on, they wouldn't have needed to do QE. I call it the ocean liners: QE1, QE2, QE3, QE4, all the quantitative easings that culminated in 2019 with the repo intervention, and then I guess you could say the ultimate crescendo, which was MMT during COVID. But they wouldn't have had to do all that stuff if they had just prevented the meltdown of asset prices in 2008. Now, interestingly, fast forward to the spring of 2020 when COVID is raging around the planet and the financial markets are imploding. The Fed did something that I had been predicting they would do. And again, I got a lot of negative pushback on this, which was that they would actually buy corporate bonds. And they did. They stepped in and they bought corporate bonds. And when they did, the day they announced that was basically when we went all in. To us, that was the ultimate green light that the bear market was over and then we're going to get a tremendous rally, even though the COVID news got worse, not better, for months and months. So they, that was a very powerful and effective intervention, which required very little money. I think the total amount that they invested during that period of, in corporate bonds was something like $20, $30 billion, as opposed to the trillions and trillions and trillions of QEs that they had to do. So, I guess my point there is there are effective and targeted interventions versus those that are, where you just kind of spray the system with money and you hope it works. And those have a lot of unintended consequences. So that reaction to bubble 2.0 of creating those trillions and trillions of dollars of QE that culminated in MMT created bubble 3.0, which I'd say was the bubble of the biggest bubble of all time, the everything bubble. So prices went nuts on just about everything with the exception of energy and some other hard assets. But that's when you had what I would call the crazy overpriced stocks, the COPs. You were alluding to this earlier, profitless tech companies they went crazy, and NFTs and SPACs and cryptos, of course. And that's when Dogecoin got up to $88 billion market cap on something that the creator kept saying, it's worthless. What are you thinking? It's worth. And then you had all the permutations, and I just don't think we'll ever go through another period that will be as absolutely deranged as that one was. I think it will go down in history as the ultimate speculative mania. And I think that at the very epicenter of that were bonds, which you might think would be an unusual speculative instrument. And it was in a way, because it was more of an indirect instrument, in that as you got interest rates negative through much of the world, there were $17, $18 trillion worth of negative yielding bonds. And even in America, which didn't go full on negative, we did get down to virtually zero with short-term rates. So it created all these asset bubbles. When money is just freely available and where you're being paid to borrow money, you're going to get all kinds of pricing distortions with asset prices. You have home buyers in Denmark that were getting paid to take out a mortgage. That's the kind of stuff that Lewis Carroll and Alice in Wonderland would create, supposedly not the monetary leaders of the planet Earth. So it was epic. It was historic. And that's why I think that to expect the relatively minor amount of damage that we've had so far to be the only, the complete payback for that kind of speculative excess is naive. I think we've got much further to go, and we're starting to see that with what's happening to prices like with office buildings, which are down 25% and still falling. And obviously there was tremendous carnage in a lot of stocks last year, but now we're getting kind of an echo bubble. And people believe that we're in a new bull market, and a new bull market in technology. Yet you look at the composition of the S&P's advance in the first quarter, it was up 7%, a little bit over 7%, and yet 95% of that came from 10 stocks. 90% came from 5 stocks. It's extremely narrow, which is not a healthy sign either. So long-winded way of saying, if you look at bubble 1.0, 2.0, 3.0, they're all connected. And each one is kind of more intense than the one that went before, and more dangerous, because there tends to be more and more leverage involved with each one of these bubbles.
You mentioned the government kind of stepping in and obviously gaining equity and bailing people out, and at the same time, obviously, making a fair amount of money themselves. And I was wondering, is there what gives you the confidence that, say, bubble 3.0 was, say, the biggest and baddest and final one, and that they couldn't do the same thing again and, say, create a bubble 4.0 which ended. And yeah, I guess, I mean, like, what are the probabilities of that, and what's stopping that from happening?
Well, once again, very good question, and it's possible. Uh, I think what's happened that's different is just the leveraging up of the balance sheets of the Western governments has gotten so extreme that it's hard for them to keep playing those games. Now, you could say, well, what if Bubble 4.0 is in, really looked at in nominal terms? And I guess that's fair to say. I think and that's a really actually a critical point. Is a lot of times when we see a bull market, a lot of that is kind of a money illusion. That if you were to deflate it by, say, the price of gold, these bull market moves are much less impressive. I mean, some of the greatest stock market returns have been from countries like Zimbabwe over the last 20 years in Zimbabwean dollars. But when you use something like gold as your ultimate benchmark, they've been in bear markets. So where I'm going with this is that I think that Bubble 4.0 could be pretty spectacular in terms of nominal pricing, but not spectacular in real money. And the closest thing I think that we have to real money is gold. It's not perfect, but it's, somebody once said it's been in a 5,000 year bubble. I think anything that can be in a bubble for 5,000 years must have some special attributes to it. So I think that's what we could have. So we could see that, the S&P is 40,000 in 10 years or by the end of the decade. But, for adjusted for the current price of gold, it might be below 4,000 on the current S&P. And that would be a very extreme outcome. That would imply almost hyperinflation, which I don't think we're going to have in the U.S. But I do think we're going to have a lot more inflation than we've had for the last 40 years. I think it's going to be a decade more like the 1970s, because I think really the only way that these heavily indebted Western governments can get out from under, especially the U.S., which, if you compare the U.S. to Japan, where Japan's got much more government debt, much higher government debt than America, but they owe it to themselves. And also Japan is a huge creditor country. So they have $7 trillion or so that the world owes them, whereas the U.S. is a massive debtor country. And we keep running trade deficits. So we keep so it's this twin deficit thing. It really doesn't get much attention anymore. It used to be a big bugaboo. The idea that you run $1 trillion trade deficits with $1 trillion federal budget deficits, I mean, that's pretty terrible. And you keep doing that year after year. And then when the kindness of strangers starts to run out, which we're seeing, so as I think you're aware, the foreign central banks have been actually divesting treasuries for years. And what are they buying? They're buying gold. Last year was the second largest activity on the part of foreign central banks of gold. So you're kind of seeing these guys wake up. And actually, it's interesting. The only year that was bigger was 1967. And that's when the fiat dollar I should not say fiat dollar, but the Bretton Woods dollar, which was at that point still backed by gold. If you were you had to be a foreign entity to be able to convert your dollars to gold. And that was, you could say they were getting wind of the fact that window was going to shut, which Nixon did in 1971. But it was actually illegal back then for U.S. and private investors to hold gold. It wasn't until 1975. So my point is, I think we're getting to a period where these foreign central banks are once again sniffing out that there's trouble coming for the fiat dollar. And at this point, it is a total fiat currency. I think ultimately it won't be. I think ultimately it will get guaranteed by hard assets to restore confidence in the dollar. I think it's going to get that bad at some point. And I think this is the year when we're going to have, what I've been calling the 4Fs, which is the federal fiscal funding fiasco, where they just, basically you have the bond market seize up, where you could have failed treasury auctions, at least at the longer end, and a real buyer strike. And that seems outrageous. Odds are it won't happen, but yet you look at the amount of money that the federal government needs to finance this year versus, say, a year ago, And the delta, the change could be something like 3 to 4 trillion because of expanding. So if you don't know this, in the first 6 months of this fiscal year, the federal deficit's 1.1 trillion. That's basically a $2 trillion annualized rate. And you've got the Fed that's in QT rather than QE. So they're selling, not buying government debt. And you've got the aforementioned foreign central banks offloading. So I just don't know how you're going to get enough buyers to show up. And especially at a 10-year treasury that's 3.5%, which is actually below the Fed's own inflation rate right now. So despite the market's complacency currently, I think it's a very dangerous situation.
I mean, in this scenario, so obviously, like the stock market coming down, tax receipts probably going to come down, but at the same time, you have high interest rates, so they're going to have more interest payments to pay, and you still have all these other expenditures in their budget as well. And so, I mean, in terms of kind of thinking about the pain and what could happen, I mean, say for example, they do have a failed auction or they can't find the buyers, then obviously their only choice, I guess, they have is to step in and resume QE, to resume buying bonds themselves. Then would you say like that is then resuming some form of bull market, but more in the nominal terms? And I guess that's when does bonds ever become a thing that you want to own again? Or are you always just opting for gold in that scenario because it's only a short-term fix?
Well, I wouldn't say just gold. I think just hard assets in general. I think the key thing is invest in scarcity things central banks can't print, things that the world really needs to run. And, that's where I struggle with the cryptos is I just don't see them as really being essential. Whereas oil and gas, despite all the ESG negativity towards oil and gas, they are essential. Uranium is essential. So I think you want to look for where are you going to have shortages. I don't think you're going to have any shortages of treasury paper. My friend Simon Mikhailovich calls them candy wrappers, treasury bonds, where they can just be created at will by the Fed and by other central banks. So I think that's a problem. I think that bonds can be trading vehicles at times. And when the yields, spike out and you can do a little bit of duration extension, but you better not overstay your welcome. I think it's a very tactical move. Or, excuse me, or I think there's maybe a little more appeal is with maybe the 3 to 5 year in the treasury market where you can lock in the yield, because I do think the Fed is going to be cutting rates fairly dramatically at some point. And so for a while, you might actually get a little bit of appreciation on 3 to 5 year maturities, and you're probably not going to get the same degree of buyer strike there that you're going to get with the longer term bonds. But I think, again, it's a very near term opportunity where you're going to have to be very dexterous, as opposed to where the trend is really your friend with things like oil, where I think oil is ridiculously undervalued. And you can even go out in the futures market and buy oil, and it comes due in 2 years, or you get delivery in 2 years at a discount from where it is today. It really should be the opposite. Inventories are shockingly low. I think you could easily see oil well over $100 a barrel later this year. And I think that's something people are not prepared for. So I do think that this could be a recession where you actually see two things that don't normally happen, and that is long-term treasury rates going up rather than down from this level, from a 3.5 on the 10-year, and oil prices going up and going up significantly in a recession, which typically doesn't happen, but it has happened in the past. It's not as much of a binary situation as people think it is. But there's just a shortage of oil that is really going to become quite shocking and increasingly apparent. It's been heavily obscured by the releases from the Strategic Petroleum Reserve by the Biden administration, as you're aware. And I think that's one reason why OPEC said enough. We're cutting. We can offset what that supply you've artificially created.
I wanna touch into the kind of the renewable energy aspect side and its play in this bubble, and then also come in how that ties to oil. But before we go there, I'd love to just hear in terms of like how you see this, I guess, sort of playing out. So like, let's say the scenario in which like they can't keep down the price of oil, the price of energy, these scarce commodities, and even say in a recession, they're still kind of trending up. And then at the same point, they have no choice but to cut rates, say with inflation still high, and they have to do that. I mean, how does that play out in terms of for the dollar? And like, I guess like the US in and of itself as well is still in a better position than many other central banks. Like, what does it look like in the country, and what decisions can they actually make, and how far? I guess like, what is the kind of the worst case scenario, and what would be the better case scenario in which this could play out, say, over the next 5 to 10 years?
I think if you go far enough out, things will correct. And, I say this almost every time I'm interviewed these days, is that I'm very bullish on the 2030s. It's the 2020s that worry me. But I think even in the 2020s, if you're bullish on the right areas, you'll do just fine. And I think the analogy, the real world analogy for that was what happened in the 1970s. If somebody recognized what was happening in the early 1970s and they positioned their portfolios properly, they did swell. Now, that meant having a lot of hard assets during that period of time because you had pretty much negative real yields. Now, there were times where real yields went positive and there were buying opportunities with longer bonds, but they were very short-lived. And I think that's exactly the situation that we have now. And of course, we had a much lower debt level so that by the time 1979 rolled around and Paul Volcker was in there, the debt to GDP, federal debt to GDP was only 25%. Now you put a 1 in front of that, 125%, and it's very difficult to drive interest rates up to a level that would actually inhibit inflation without crashing the system. So here's the payback from bubbles 1.0, 2.0, 3.0, and all the responses to those, which have created this incredible vulnerability, fragility of the financial system. I mean, just we saw that. I mean, it's amazing how quickly people forget. Just what was it, 6 weeks ago when these banks started going down, and basically it forced the Fed to go back into a de facto QE mode. I know it wasn't exactly QE because they're charging a high interest rate for the banks that are going to the discount window, for example. But still, it shows that I think that was a revealing event that kind of it heavily validates what I've been describing, which is that when push comes to shove, and it's a question of, okay, do we continue to try to control inflation, or do we cave in to maintaining financial stability? The Fed will cave in and maintain financial stability. My great friend and partner, Louis Gobb, believes that's now the third mandate of the Fed, is maintaining financial stability. I think he would also say there's a fourth mandate, which is likely to come out too, and that is to fund the federal government. So they got a lot of mandates, and I think it's a classic example of mission creep. It's hard enough to try to maintain low unemployment and low inflation. I mean, the two kind of fight each other, right? If you get it, and that's where the Fed is right now. They're trying to get inflation down, and to get inflation down, they need to get unemployment up. But then you start putting in financial stability and funding the federal government. I mean, it's talk about mission impossible. I mean, I don't think Tom Cruise could handle that one, much less Jay Powell.
I mean, I've heard kind of the idea of sort of financial repression and just letting inflation run high enough above actual yields and sort of just inflating away the debt in that way. I mean, how real of how possible of a scenario is that? And once again, what is there any way out for them beyond that, or some mass restructuring?
I don't think there is, but I think they have to play a credibility game. I think, plausible deniability, whatever way you want to say it, I think that part of their strategy or their gambit needs to be that they convince the world that they're really serious about fighting inflation. But we don't have to create some kind of scenario that is a figment of your imagination or my imagination. We just have to look back at history. They did it. They did it very successfully from the end of World War II until when Volcker came in. That's when there was a lot of, for a while there was overt suppression of interest rates. There was Operation Twist. The very first time the Fed basically tried to force longer term interest rates down. And I think we will get an updated version of Operation Twist. And I think for a while it'll work, because you think about it, there's tremendous demand right now for short-term treasuries, right? The 1-year T-bill yield is 3.5%. The 3-month T-bill yield is 5%, which is pretty bizarre. I mean, that's That's a very steep yield curve from 1 to 3 months. But it's, the debt ceiling fears are in there.
Mm,
But I think they have to do something to convince the bond market not to totally give up on providing financing to the federal government. I think that for the Fed to do it all and go full on debt monetization like a Zimbabwe did or Venezuela has done, and Turkey has done to a certain degree, they don't want to go there for obvious reasons. So they're going to play a very convincing game that it's still the economic paradigm and fiscal and monetary paradigm of the last 40 years, but it's not. They're really in an impossible situation, but they can't admit that. So it's going to be a
mm,
very exacting, a very complex cat and mouse game they play with the bond market. So it's important for Powell to make it look like he's got this inflation thing under control, but I just don't see how he can really pull it off.
mm. Which, I mean, I guess it's a nice little runway into kind of one of the larger reasons why he can't pull it off in terms of the shortage of oil and just generally useful and scarce commodities. And I think the first time I kind of heard about this, well, the idea of like a commodity cycle and what causes it. And then also, I guess, kind of the shortfalls with renewable and the kind of the push for green at the moment and how that can affect us in terms of the inflation that it can cause. And I'd love for you to kind of give your overview first on, I guess, kind of renewables and how it kind of plays a part in this bubble and potentially makes life harder for the central bank, and then pivot into
Thank you
oil
for
a bit
that
from there.
segue. That's good because actually, ironically, the very first chapter of Bubble 3.0 that we published it early. That's one of the nice things about doing it digitally. You can pull chapters out of sequence. So the first one we put out in our newsletter was either October or November 2021. It was on greenflation. So that's a term that I think I coined. I hear it used once in a while now, not as much as a year ago, but this idea that the great green energy transition is quite inflationary. And I think it is. And I think the evidence is overwhelming that it is. And I mean, I get the appeal of renewables to a point, and I think that's the critical part to a point. When you try to push them from more of a peripheral source of energy to the primary source of energy is where I think you get into a very dangerous and inflationary situation, because you're moving, and I've written about this, talked about this for the last couple of years. You're moving from a denser form of energy in terms of fossil fuels, and especially nuclear. Nuclear is the densest form of energy. You get the biggest bang for the buck from nuclear energy, to less energy dense sources such as wind and solar, or even burning wood, which is very popular to do in Europe these days, even though it actually emits more effluents into the atmosphere even than burning coal. And by the way, coal usage is at an all-time high. So here, after all these trillions that we've spent on moving away from fossil fuels, we're burning more coal than ever, and we're also burning, at least in Europe, a lot of American wood, and some of it's coming from virgin forests, American and Canadian, and even Eastern European. I think there's just tremendous flaws in the great green energy transition. And a lot of it is by trying to do too much too soon, and by being very unwilling to consider things like nuclear energy. I mean, Germany's shutting down their last 3 nuclear plants. I don't know how they can do that after what's happened with losing their Russian energy sources and Nord Stream pipeline being blown up. It's just stunning to me. It's just utter idiocy as far as I'm concerned. But they just keep doing this stupid stuff. And if you look back at the last 15 years, Europe has its energy production, domestic energy production, has gone down steadily, and up until the invasion of Ukraine, its importation of Russian energy went up steadily. They were like, mirror images of each other on a typical XY chart around the diagonal line. One going one way, one going the other. But anyway, it was just utter nonsense, and yet they don't get it. And so I think it's baking in a higher level of inflation because energy is such a critical component to the global economy. So if you're going to have higher and higher priced energy, and of course part of this is that traditional fossil fuel producers don't want to produce, or at least they don't want to produce on a long-term basis. In other words, they'll do these short cycle projects where they can get which is why the Permian Basin in Texas is so popular, because you have virtually no dry holes, and 80% of the oil and gas comes out, especially the oil, comes out over the first 2 years of a well's life. Whereas if you go and you're going to develop some big new field in the Gulf of Mexico or up in Alaska, I mean, you're looking at 20, 30 years, and they don't know what the market's going to be like, whether they'll be legislated out of business. So the net result is we've got basically 10 years with capitalist spending starvation in the energy industry. And so that's creating a shortage situation. And yet the demand for energy continues to go up. And I mean, fossil fuel energy continues to go up. I already mentioned coal, but oil demand is at a new all-time high, despite the fact the global economy has been sputtering. And of course, China, had a virtual recession, and now they're opening up. And so oil demand is going up in China. Oil demand is growing about 500,000 barrels a day per year in India, which is now slightly more people than China and a much lower oil usage per capita than China. Of course, China's way below the United States. So what people are missing they're not getting this mega bull market in oil is that the demand is not going to grow very much, probably contract in the OECD, the rich world, but it's going to grow drastically in the developing world. It has, and it will continue to do so. And part of it is that in a lot of those developing countries, say, well, yeah, they're going to buy a lot of cheap Chinese EVs. I think to a certain degree they will, but the grids aren't very reliable. So, and a lot of times those cars are more expensive than internal combustion engines. I just think this idea that oil and gas are going to become obsolete in the near term is ridiculous. I think there'll be more oil and gas consumed in 2050 than there is today. But there's things we can do. And one that's unheralded is if you go to the EPA, the Environmental Protection Agency of the United States, their own website, and see how much U.S. air quality has improved over the last 50 years, it's unbelievable. The amount of effluents that come out of the tailpipe of a car today versus 50 years ago is minuscule. It's a tiny fraction of what it was 50 years ago. And why did we not put the kind of effort into further reducing tailpipe emissions from companies like Corning that came up with the original catalytic converter, and they now have a Durafilter, which is even more effective? To me, that seems a lot smarter than trying to go all EVs, where there are still, for example, in China, if you've got an EV in China, you're actually polluting more than with an internal combustion engine because it's largely coal fired. Because you plug it into the grid is 60 to 70% coal in China. So that really doesn't make sense. But from China, they've got I think their goals or objectives are different. They don't have oil. They have very little oil, so they have to import oil. They've got a lot of coal. They control so many of the critical great green energy transition materials and resources. Their lithium processing. Obviously, they're highly dominant solar panels. So I think the West has to be very careful about what they're doing. We could be making ourselves extremely vulnerable to China for future energy.
And I guess like the other part in terms of the whole thing with oil and the inflation is that green inflation wouldn't be as large if it was more a matter of just like promoting renewables and trying to shift more. But I think the big like aha moment for me is like, then we're not just trying to do that, we're also trying to actively stop oil companies, all this kind of thing. And like if you don't reduce how much you use something and you simply try and reduce the supply of it, then the inevitable result is that it's going to become more scarce and more expensive. So although say short term as an oil company, it might be painful not to go out and drill more wells or something. If all of a sudden no one is going out to drill more wells, then at some point there's going to be a supply crunch because we're not cutting down how much we're using it. And I guess that is when the price starts to go up, which we're starting to see now. And I wonder, is there any argument for the case that, well, maybe you need that for the price to go up in order for, say, some theoretical innovation to happen with renewables? Because I mean, it on the other hand, it does seem like all it is going to do is once again, as you see, we have coal, like certain coal stations coming back on. And at what point, how bad does it have to get for us to kind of loosen up and realize, oh, maybe we need to do and put some more focus into oil or gas and not kind of hit them so hard with all these windfall taxes and all this kind of thing?
I think with a certain cohort of our political leadership, that answer is never. There'll never be a set of circumstances that will really cause them to believe that we should create a more friendly environment for fossil fuels. I just don't think that's going to happen. Now, if there are those that are a little bit more pragmatic, that like what happened with the Biden administration here recently, where they decided, well, we do have to try to encourage some development of oil and gas, but I think it'll be infrequent and sporadic, unfortunately. But American ingenuity, I mean, human ingenuity is limitless. And I do think we're getting very close to the point where small modular nuclear reactors are going to proliferate. I think your country, because you're based in the UK, will be one of the leaders there, partially because they have to. So, I mean, just if you look at what happened with Germany with LNG imports and import facilities, and they were very hostile towards LNG, the European policymakers, until the Russian thing happened. And then it's like almost overnight they were able to build these temporary LNG facilities, and frankly, that's going to be a big positive for the U.S. natural gas industry because they're going to continue to need additional LNG imports, and the U.S. is now the largest LNG exporter. So it is funny that when things get bad enough, some of the decisions, the compromises that are made out of necessity. But it takes an awful lot. It takes a very dire situation to create that kind of a acknowledgement of reality. So I just think we're in this long battle where we're going to continue to try to put millions of additional EVs on the road, despite the problems with the grid, despite the problems with building new transmission lines that are essential to be able to enhance the reliability of the grid. Building a new transmission line in America is almost impossible. I don't think it's too great in the UK. No, it's terrible in Germany. They've had a major problem trying to build transmission lines in Germany. There just are so many nonsensical aspects of this great green energy transition. Just copper. Copper is essential to it. A typical EV uses something like 3 times as much copper as a traditional auto. And there's not enough copper in the world as it is. Copper inventories, like oil inventories, are extremely low. So we're going to drive the demand through the roof, try to build a new copper mine. We just saw in Chile that they've nationalized their lithium mines. I wouldn't be surprised if they nationalized their copper mines. And when you nationalize things, what happens to output in the long run? It doesn't go up. You just look at these energy companies that have been nationalized. Whether it's Venezuela. Venezuela is a classic example, and they've got greater oil reserves than Saudi Arabia, and yet they're producing 700,000 barrels a day versus Saudi Arabia's over 10 million. And Mexico nationalized their oil industry. Their oil production is way down over the last 20 years. So that's a trend that really hasn't got a lot of attention. As these countries realize that they are the owners of essential great green energy transition materials, there is a tendency to want to nationalize. And the impact on future supply is terrifying. So, at some point, I don't know, I think you're going to see the world bifurcate between those countries that accept reality and those that deny it. And for right now, I'd say America is still very much in the denial mode. We can't finish the Mountain Valley pipeline, which is 95% complete, to bring cheap natural gas to the Northeast, where there's a real serious energy poverty situation. There was a serious energy poverty situation in your country last winter. I don't think those times are over. I think we're going to have another energy crisis in Europe coming up soon. A lot of bad policies out there, unfortunately.
Yeah, it's not setting up to be pretty, and it reminds. I don't know if you've read the Fourth Turning. But it does seem that after this after these 80 years, however you want to call it, of kind of relative peace, we are entering into definitely a more crisis driven kind of period. But as you say, like the 30s after that kind of do tend to then be like almost a restart. And I guess also ties into kind of the 100-year debt cycle as well. And one thing I wanted to touch on a little bit is kind
Sorry,
of,
did you say the fourth turning? Is that what you said? Fourth turning?
yeah,
So you're
yeah,
talking about Neil Howe's theory? Neil Howe, the demographer? Yeah, his
yeah.
work is fascinating. And I think so much of what he's been predicting, we're starting to see really play out. So I think you're exactly right, and he's exactly right. And I think he's kind of, I know, in fact, I just read recently where he's kind of saying the same thing about the 2030s, that could be a much better time. So these transitions are always very scary, but that's when you tend to create the critical pathway for the next boom. But I think we've got this debt overhang that we
Mm,
have to come to terms with, and that's why I think ultimately we're going to have to create, whether it's treasury bonds and a U.S. dollar, both that are backed by hard assets. Or, one of the things that I brought up here in a recent podcast I did was the U.S. has got this. I mean, if you think about where is the wealth in this country, who owns it? It's mostly my generation. There's still the greatest generation, a few people there, but mostly it's the baby boomers that have, I don't know, 100 trillion. I don't know what the real number is. I'd like to know that. Maybe Neil Howe has done that work, but let's just say it's $100 trillion. And as we die off, if you have an effective estate tax, not even a wealth taxes are tough because they encourage people to leave their country. But an estate tax, I mean, really, I don't pay it. My kids pay it. And if it was set at the right level, like 25%, you think about how much money the U.S. government could generate over the next decade to 2 decades. It would create, it would eliminate, if we could get our spending under control so that we're not constantly increasing the amount of deficits and accumulated debt, we could be very healthy financially in 15, 20 years. And I think something like that's going to happen. And I think it'll be in conjunction with an energy miracle and maybe AI that is used. It's a very dangerous technology, of course, but if it's used properly, that could be another positive game changer. And the medical breakthroughs that are occurring are stunning. And so I think there's a danger in getting into this end of the world mentality. I don't think that's proper. I think it's realistic to say we've got some really severe challenges, and probably the biggest challenge our country faces, and I think your country too, is debt levels that are just unsustainably high.
mm. I want to touch on demographics a little bit here because I mean they're the kind of the big thing that no one talks about until all of a sudden they seem to matter. And I mean, like say China, their population is kind of peaking. Like the US, like most countries, kind of population growth rates don't look good, other than kind of a few select countries like say India. And I was wondering like how you view kind of say the situation here in the West, like in the US and like kind of the UK with the population, and like what effect will kind of this aging population, like what effect will that start to have once again on I guess kind of the economy and just kind of like the financial monetary system as a whole? Like will that, how much more pressure is that going to put on the kind of the debt system, and how much more they're maybe going to have to put into sort of healthcare and all this kind of stuff? And yeah, I'd just love to hear like, yeah, how you think about demographics and where we are with them now.
So you said how much more pressure is it going to put on the system? And my short answer would be a lot. And it is the
Mm,
number one problem. So the current reigning bond king, Jeff Gundlach from Double Line, guesstimates that the unfunded entitlements are on another $150 trillion on top of the federal debt on budget, which is about 30 trillion. There's just no way the economy can possibly support that. So what it's creating is this generational conflict. I mean, at some point, the younger folks, I think it's already happening, are waking up and saying, why are we going to deal with this debt burden? It's kind of like student loans in a way, where you have this enormous future debt burden that the younger generations are going to be faced with because of paying entitlement benefits to my generation. And at some point, they say, no mas, and we're just not going to do that. Now, how will
mm,
that play out? Will it play out in kind of a stealth civil war? Don't know. Overt civil war? I sure hope not. But I do think society is fracturing and polarizing. And there's those people that feel like the system has been just fine for them. I'm in that category. America's been very good to me, but there's a lot of people that have been tremendously disadvantaged and disenfranchised by the policies that this country has followed over the last 25 years. I mean, I haven't talked about this in a while, but I think one of the biggest scandals is that there are no assets in Social Security. It's just a bunch of, again, candy wrappers, government IOUs. Why? Why wasn't that funded like the Norwegian sovereign wealth fund, with real money? Why was it not in a balanced portfolio of corporate stocks and bonds instead of more government debt? Imagine having a private company, that funded its retirement plan with its own debt. People would say, that's crazy. That's not any degree of safety. It's far from it. But that's what, and every time there was an attempt at reforming Social Security to move, now there was a thought about doing like Chile privatizing, and that's controversial, but you didn't have to go that far. You just needed to put real assets in the Social Security Trust Fund. And they didn't do it. And it was running enormous surpluses year after year, decade after decade. It could be the biggest pool of capital on the planet. But somehow we didn't do it, and somehow we don't criticize our policymakers for allowing that to happen. Well, now we have to deal with that. Now we have to pay all these boomer retirement benefits without any money to do it. Where's it going to come from? And I think at some point the younger generation said, well, I'm not going to pay higher taxes to pay for my parents' Social Security that is now, there's nothing there. So it has the potential to create some very, very severe intergenerational strife. But I think we're going to have a very tumultuous decade, and unfortunately a lot of civil unrest. And I just hope it doesn't get way out of control.
Yeah, I guess there's no way of knowing really, how bad it can get. Hopefully it's somewhere down the middle, but who knows? I want to kind of talk into now, like as an individual, in terms of kind of protecting yourself, because obviously we spoke about hard assets, but I mean, especially like my generation, I feel like we've all been kind of brainwashed into like the Bogle kind of idea of just like stick your money into like the S&P 500 and kind of leave it. And I wondered what your thoughts are on that. And I guess one way you think it's going wrong, but how you rectify that in your mind, because like whether it is just going for active funds, because I mean, like even with say active funds, like finding funds that say kind of have your theory and ideology and aren't just going for like your standard ESG investing, and that sort of thing. Like how does say a young person at its simplest go about protecting themselves? And what is kind of wrong with, or what is your opinion on kind of the Bogle idea of just sticking it into the S&P 500 index fund?
I think the biggest problem is it's done so well for so long, that approach. And like anything in the investment world that's done really well for a very long period of time, that tends to squeeze the future return out of whatever it is. So, I mean, this goes back to what I was saying about my career and how I really built it on taking advantage of the fact that bond yields were so high 40 years ago, and there was kind of this residual kind of inflation of bond yields because of that experience in the 1970s. In other words, bond yields were a lot higher in the 80s and 90s, and even in the 2000s than they should have been, based upon where inflation was. But there was kind of this muscle memory of, well, boy, in the 70s bonds, 60s and 70s bonds were just terrible. Therefore, stay away from them. So if you stay away from them, then their yields get high, right? The lower the prices are for bonds, the higher the yields are. And then at the same time, stocks are very much tied to interest rates, so that when stocks are very depressed, usually interest rates are very high. So as interest rates came down, that created this tremendous uplift for stock prices. And again, it ran for basically 40 years. Now there were some exceptions to that. And for example, the decade from 2000 to 2009 was a really tough one. So you did well with bonds, but you did very poorly with stocks. But one of the key points of my book of Bubble 3.0, which again, we got it out in early 2022 before this actually happened, was that investors were likely to lose on both sides of their portfolio using that kind of traditional balanced index portfolio along with bonds. And sure enough, in 2022, that's what happened. Bonds went down, stocks went down. That's why it was the worst year for balanced portfolios since 1871, 150 years. That's kind of a long time. So things are already changing. It's no longer just me, saying, hey, you better be, listen to your Bob Dylan tune. The times are changing, and they have, and I think they will continue to. I think for young people, you're going to be pretty well protected because your income's inflation adjusted. Hopefully, the main asset you have is your home, and to the extent that you have financial assets, I would skew them towards. You can use ETFs, so you can still use index vehicles, but they tend to be more specialized. So, that there's a uranium ETF, the Sprott. Sprott's certainly one of the best at managing natural resource-based vehicles. SRUUF is the symbol for their uranium ETF, and it's pretty depressed. The uranium itself has bounced around, kind of in the 40, 45 range, and that's just way below a cost that is going to stimulate or incentivize future production, which needs to happen. China has 150 nuclear plants under construction or in the planning phase right now. So there's going to be a lot more uranium used over the balance of this decade than has been the last 10 years when you still had a lot of decommissioned nuclear weapons that were producing uranium. The U.S. is really just produces very little uranium, and we rely heavily on Canada and Uzbekistan, which is obviously not a very safe venue. And so I think that's a great bull story. I think natural gas, which in the U.S. is back down around $2 per million British thermal units, MMBTUs, is nuts, way too cheap. But as I said, oil, it's crazy to have oil around $80 a barrel when that's where it was 15 years ago, 16 years ago even, and adjusted for inflation. And when you're looking at a dire shortage, you could have easily a 2 to 3 million barrel a day shortage by the end of this year. That is huge in the oil market. The oil market is about 100 million barrels a day. 1 million glut, 1 million deficit, that's a lot. 2 or 3 is ginormous, to use a very technical term. So again, I would just say, and again, there's ETFs. If you just say, I don't want to pick stocks, buy an XLE or another, energy ETF, or buy the USO, which is the oil ETF, which actually benefits right now from the structure of the market. It's called backwardation. I don't want to get too technical, but just trust me, it's a good thing. Backwardation is beneficial to the USO ETF, whereas contango, the normal, is disadvantageous. I think the fertilizer stocks, which have been crushed, look very interesting. So there's all kinds of ways a young person can position with their financial portfolio. But I think the main message I would have is don't despair. This will work itself out. I think it's going to be your generation that gets to clean up for the idiocy of my generation, idiocy and self-centeredness, which is appropriate for the me generation, right? I think we made just a series of policy blunders because we were trying to do things that helped us and helped get elected these vote-buying politicians who have absolutely mortgaged the future of this country, over-mortgaged the future of the country.
Yeah, I mean, that's basically the kind of the approach that I've been going with my own kind of humble savings and that sort of thing, and that I just want anything hard asset-y. So, I mean, I'm lucky we live in the countryside as well, so we've got some like farmland. But yeah, like uranium ETFs, natural gas, like like looking at like midstream oil companies and all that kind of stuff. But I guess like one thing which like has me questioning more is like in terms of like obviously having say a high percentage in all these kind of very commodity based commodity based assets, I guess like it goes against what like you read about in terms of like risk management and like how much of like everything you should hold. Like commodities maybe should be like 10-20% of like your investment portfolio, say, and even that like some people will say could argue is like high. And I like in your head, is that something that like in terms of that's just old thinking, and like for you like having these kind of scarce things is the safest thing and the majority of what you would want to hold, aside from say kind of select other maybe more value dividend paying stocks? And so do you think we almost need to rethink as like a kind of, generally rethink in terms of how much of a portion commodities and like kind of, scarce metals, how large of a portion they should play in like a risk managed portfolio.
Well, you raise a very valid point, and I really haven't spent much time on this in our discussion, but I write about this a lot. I think a barbell approach to portfolio structure is appropriate right now. So I think when you've got 5% on short-term governments, that's a great place to have a lot of money. That could be 25, 30% or even more of your portfolio. And there's other areas that are more traditional income producing that I think look attractive. I think the high quality mortgage REITs. What we're positioning for now is a steepening of the yield curve. I think that's going to happen and fairly dramatically. And typically that would be good for longer term treasuries. And again, trade those things. There could be some opportunities. I don't think at 3.5 on the 10 year is particularly attractive, but these mortgage REITs are yielding double digits, and yes, they are riskier. That would be maybe a 2 or 3% part of a portfolio. But I think emerging market debt, and there's a number of closed-end funds that you can buy in the U.S. I'm sure you can in the UK too, where the emerging market debt is perceived as riskier than the U.S. debt. I think that's going to invert. I think people will look back and say, boy, why was I not buying Indonesian government bonds when they were yielding way more than treasuries and their financial situation was much healthier than the United States. So when you say emerging markets, there's a lot of variability in their fundamentals and their strength. But in general, I think the emerging market debt, a vehicle like the Templeton Emerging Market Income Fund, TEI, that's one of my favorites, selling at a big discount from net asset value. It's been a dog for a number of years. But actually, emerging market debt is already outperforming treasury debt, has for the last couple of years. So it's showing relative strength for the first time in quite a while, but it's still very, very cheap. So again, there's ways to do this that are not just buying commodities, but acknowledging that this is not the same environment that we had from the early 80s to 2020. It's a very, very different one. So to invest the same way, I think is just, obviously not correct. I mean, if the situation has changed that radically, and I don't see how you can argue that it hasn't, then your investment approach needs to change radically as well. So I wouldn't, you get percentages, and it depends on your age and your risk tolerance. But I certainly don't think having 30 to 40% of a portfolio in a very diversified series of asset classes that have hard assets some way, shape, or form is out of bounds. But again, it depends on your risk tolerance. But I think there's a false sense of security in holding, like say, if somebody was going to be all in treasuries, you would say, well, that's very safe. Well, really, is it? Is it really safe to be all in treasuries in an inflationary environment? Now, if you believe we're not in a structurally inflationary environment, that's a different story. I think we are. I think we're going through a period where inflation is cooling off temporarily. But as we get to the situation where the Fed is going to have to step back in to keep things going, then we're going to realize that inflation rate is only down for a short period of time and is going to reaccelerate.
Yeah, I mean, I guess like emerging markets was the other thing I was going to ask you about, because I mean, like Latin America and kind of these countries in a commodity bull run obviously do fairly well given what they produce. And I guess like in an interesting way, like say somewhere like India is like kind of playing the emerging markets, but then also like they will struggle a bit in terms of with higher oil prices and that sort of thing. So I guess that's a way to kind of think about diversifying purely just from the commodities, but still being in kind of someplace growth. But I mean, yeah, I feel like, because like obviously the most touted thing is like just buy the S&P, but like there's a part of me that just doesn't want to put anything in the S&P 500, because I mean, not only because of kind of this commodity situation, but also in terms of just like its returns relative to emerging markets and the rest of the world, and how much of say like the people in the US and like in other countries hold US stocks compared to anywhere else. It kind of feels like why would you ever put money in the S&P when there are so many signs that kind of point that it's like to an extent overdone compared to everywhere else?
Well, I think simplistically that if you had a choice between the S&P and an emerging market non-US index, I would take the emerging market index. And on the fixed income side, I would do the same thing. I would favor emerging market debt versus developed market debt, particularly the U.S. So yes, I think that's correct, and it also kind of fits within the normal cyclicality of things. It's been a long outperformance cycle for the U.S. Equity in particular, but even U.S. debt until recently, where again there's clear signs that it's shifting. So yes, I think that's well said.
Okay. I want to touch on, as we kind of wrap up a little bit, I thought it'd be interesting to talk about gold and kind of I guess the kind of some comparison that people say between gold and Bitcoin and that kind of thing. And so I'd love for you, like, in terms of gold, aside from its history, like, with its, like, it's obviously got certain key properties which make it suitable for money. And like gold is one of those interesting ones which, like, although you want to hold useful things now, like gold in and of itself is not useful other than the fact that it's scarce and it doesn't change. And yeah, and it's kind of like divisible and all these like classic properties of money. And in terms of, say, like Bitcoin, in what way do you think they differ, other than the history? And like, say, for example, now, like a central bank is clearly not going to be buying Bitcoin; they're going to be buying gold. But kind of more long term, as like, say, the dollar has trouble, and kind of people just look simply for scarce things which are divisible, easy to send. Like, what is it? What would you say is like the one thing about gold, or that what you prefer over Bitcoin, and then one thing about Bitcoin that you just plain don't like for now, and why you wouldn't hold any in a portfolio?
Okay, I'll start with the last part first, because what I do think there's going to be a buying opportunity in Bitcoin. I struggle with it because it's an odd security. It's not really a security. I'm not sure how to describe it, but what really worries me about it is Tether. And it's amazing to me that Tether has not been busted yet, because so many of these other things have failed. And when that goes, I think Bitcoin could really get blasted. I mean, below 10,000. Could be wrong about that. We got close, though, not too long ago, and Tether was still there. So I guess the fundamental flaw I see with the cryptos is you still have a fiat on-ramp and off-ramp. Now, maybe that's going to get changed over time. I don't know quite how that works, because we live in a world that, you need to have some kind of fiat currency to live with. And maybe Bitcoin at some point doesn't need an on or off ramp. And at that point, I guess I'd get more interested, but I don't think we're there yet. So it's just such a hazardous area. I mean, I've been saying this for years, is that, how do you know that well, first of all, the best advice I gave anybody on crypto was back, and this was because of my friend Grant Williams in the summer 2021, get your Bitcoin off the exchanges, because the exchanges look extremely hazardous, which turned out to be true. So it's such a high risk area with so many imponderables and unknowables. I mean, I think they're great trading vehicles, and I would probably use technical analysis. It seems to me that when these things get absolutely crushed and greatly oversold, there is a trading opportunity. But then they run, and personally, I've made a lot of money shorting cryptos through kind of the indirect plays, including, fortunately for me, Signature Bank. But there's some others. I guess I'm not going to name it because it probably wouldn't be appropriate. But there's some other ones out there that when Bitcoin and the other cryptos get hit, it's going to go way down. One in particular where the guy is very, very vocal and has leveraged up his company to buy Bitcoin. So you probably know who I'm talking about. But let's talk about gold. So you already hit on it, the fact that when have you seen a central bank accumulating, other than maybe El Salvador or Nicaragua, whichever it was, accumulating Bitcoin? No, they don't. They accumulate gold. And one of the reasons I think they're accumulating gold and so aggressively right now is the suspicion that these so-called wealthy countries that are also heavily indebted, like the U.S., will need to recalibrate the price of gold at a much higher level to then back up their currency. So maybe mark up gold from 2,000 to 20,000, and almost overnight, and say, oh, by the way, now and it would probably be, so as you know, in China, there's a renminbi and the yuan. Renminbi is internal, yuan's external, right? I think I have that right. But my point is, and this used to be the way it was with the dollar, as I mentioned earlier, there was a dollar which was exchangeable into gold for foreign investors. This is back in the 60s, up to 1971. And then you had the domestic dollar, which was not exchangeable. I think we could be going back to that again, where for international investors, they're allowed to redeem and get gold for their dollars, but not at 2,000, at 20,000 or some number like that. And I think that's what's behind some of this central bank transition or flight into gold is as an optionality. I mean, it's a pretty good deal anyway. If you look at the price of gold, and the people at Gary and Rosenzweig do great work on natural resources, and they allege that if gold was really at the same level, had the price increased at the same rate that the money in the system has increased, gold would be at about 20,000. I think their official target for the end of the decade is somewhere between 8 and 10,000 on gold. That's the kicker. It may not happen. It probably would be good for society if it doesn't happen, but it could happen. And I don't think you're going to lose a lot of money with gold where it is now. So your upside downside is quite attractive. Then you get into the miners, and some of those guys have just tremendous upside. In fact, pretty much all of them have tremendous upside if you get gold even to 3,000, much less 8 or 10 or 20. So kind of a long-winded answer to a pretty short question.
No, it's a good answer. I mean, both of those, they're both things that I think of a lot and I ponder. And I mean, like Tether, I mean, there's arguments where some people it cause short-term pain, but that money has to go somewhere. Like a large of it probably just go into, say, USDC or to dollars in general. But some of it might just be forced to go into Bitcoin. That is the most common pair in a sense. And then in terms of the on and off ramps, another thing.
Bitcoin's got some special attributes for sure. I wanted you to be clear that it has its scarcity, unlike Dogecoin, which can be just created at will. So, and it's got the whole blockchain. It's got a community. It's going to be around. So I think it is one to buy on weakness. I just think the ultimate weakness would be the flush out of, people call the stable coins. I call them the fable coins, like Tether being the most fabled of them all. It seems to me a complete fraud. But maybe I'm wrong. Maybe I'm being too harsh. It's hung in better than I thought it would. So I got to give it that credit. It's withstood a lot of stress here over the last couple of years.
Yeah, no, I mean, I agree. There is definitely a crazy amount of fraud, but it's just a matter of, I mean, it's like how far they can push it down the line and whether they can be okay. Yeah, I mean, who knows? We'll kind of see how it plays out. But I mean, I feel like I've covered pretty much most of what I was kind of hoping to dig into. And it's been super, super, super insightful kind of speaking to you and digging into all this. And I mean, I guess what kind of, if you could leave readers of any kind of final thoughts or things to kind of ponder on or think about, what would they be?
Yeah, good point. Because we did talk about this aspect, which is it's been the most powerful money-making tool I've ever come across. And I know that sounds like clickbait, but let me explain. And it has to do with something that, you know who Paul Tudor Jones is, right? Famous trader, one of the most famous billionaire guy. And he calls what I'm going to describe range expansions. And I call them breakout and breakdowns. So what he means is that if you look at a security, it really doesn't matter what it is, and it's been in a long-term trading range. And long-term is the key. So if the trading range has lasted for a few weeks or a few months, it doesn't mean much, frankly. What we have found, my team and I have found, is that at about the 3-year mark, you get into a real serious, it's a range or a band that if it's violated, it means something. So specifically, if a company's been trading between 20 and 40 for at least 3 years, and it breaks above that, which I will say, surprisingly, right now in what is still a bear market, there's a lot of companies that are breaking above their 3-year ranges. So they're having a range expansion to the upside. When that happens, it almost always continues to happen. So once it occurs, if you do 20 to 40, it's going to 50, 60, sometimes way, way beyond that. The same thing on the way down. I mean, look at the chart prices of First Republic and Signature Bank and SVB. Now, these breaks were very quick. So you really had to move almost at the speed of light when they made their big breaks, but you would have saved a tremendous amount of money. Or another one is to look at Credit Suisse. When Credit Suisse, that one you had more time to react. So it's a huge way to save. I mean, just think of, we've all had in our lives situations where we've lost a lot of money, because something keeps going down and go, oh, it can't go lower. This is a great buy. I'm going to buy more. And that can work within, kind of within this band, within the range. But when it breaks below that, it is telling you something's wrong. Now, the most powerful, and this is one of the worst mistakes in my career, was when the S&P broke out of its 13-year trading range from 2000 to 2013. And it was in a 13-year trading range. When it broke, that was an extremely bullish signal, which I missed. Partially because I didn't fully believe in this whole theory that I've been kind of creating accidentally, kind of stumbled on, because I'm a fundamental guy, not a technical guy. But fortunately, I did pay attention with Microsoft. Microsoft was the same thing, which I stuck with and hung with. And, 13 years it was in a trading range, and it broke above that in 2013, and then it was off to the races. And one of the good things is that you can pick up, if you follow that system, you can pick up on companies that go from being value stocks. So if you look at Microsoft, it was the ultimate growth stock in the bubble 1.0. By 2013, after bubble 2.0, it was the ultimate value stock. It was trading at 10 times earnings, huge free cash flow yield. Then it became a growth stock again. If you can get a company to go from a value stock to a growth stock, you make a lot of money. And these guys, this approach, this technique gives you a way to filter and screen for companies that are doing that. And what's interesting, and I'll tell you another personal sad story, is that because I have a long short account with a lot of the companies that I sold short, I lost a lot of money because I didn't pay attention to that. Tesla was the biggest failure on my part. When Tesla broke out in 2021 is when it really had the big breakout. Might have started a little bit before that. But anyway, it broke out of a long range, and I ignored it. And I could have bought a fleet of Teslas for how much I lost on that position. I mean, the old saying, hoisted by your own petard. I mean, that was just like, how could I have been so stupid? Well, I got religion. I learned the hard way that when these breakouts happen and you're short, you better cover, because you can get annihilated on the upside. It's way more dangerous to sell short than it is to buy a stock. So I can't emphasize enough how often that gives you a great, and the other thing too that I was going to say is same thing with macroeconomic data. If you looked at the unemployment rate, if you looked at inflation, just to pick the two probably biggest macroeconomic developments back coming out of COVID, it was screaming that we were going to have tremendous growth in employment and that we were going to have a breakout in inflation. That inflation trading range that had held for so long was violated very clearly in 2021. I just see that happening time and time and time again. So it's almost like fractals in nature, and fractals in mathematics, that they appear in math and they appear in nature. And so if people pay attention to that, I think they'll do really well over their investment career. Learn from my mistakes. It's a lot cheaper to learn from somebody else's mistakes than your own, right?
Yeah. I mean, unfortunately, sometimes you have to learn from your own as well, because it's not enough. But great, good take. I remember you speaking about that on don't know if it was your last, but a Grant Williams podcast you did a while ago with him. And it's one of those things which feels so simple that you're like, surely not, like surely there's got to be more to it. But I mean, sometimes simple is good, isn't it? So yeah, thank you.
That's so true. I just want to emphasize you're exactly right. You're so right about that it seems so simple, and that's kind of what I thought. Well, I can't really work. I mean, I even when I kind of watched it and was telling people about it, I didn't really fully get it and believe it in my heart. It's just, but sometimes the best strategies are the simplest ones.
And I guess almost the least used as well, which is probably why they work to an extent, because everyone's too busy trying to find a more complicated tactic, which they think must surely work better.
Exactly.
Right. Well, thank you, David. It's been great speaking to you. And see you.
Thanks. It's been great being on here with you. Thank you so much. Look forward to chatting with you again soon.